Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Balaji Venkataraman. He's Vice President and Client Portfolio Manager over at American Century to discuss where the best value and opportunities are in the fixed income space. Balaji, it's great to see you. As always, welcome back to Trade Talks.
Thanks very much. Appreciate it, Jill.
You got it. Obviously, a lot of talk with bonds this year. Yeah. What has changed to make them more attractive versus last year?
Yeah, I think it's been interesting. If you think of 2022 versus 2023, we've really flipped the entire story for fixed income. Right, last year really about rising interest rates dominating fixed income performance, the Fed and inflation. This year we're not necessarily in a rising rate environment anymore. I don't think people need to be afraid of rising rates anymore. We actually think we're probably in a falling rate environment, and so that creates a lot more opportunity in fixed income. There's more yield available after what the Fed did over the last 12 to 18 months. There's more return potential available if you do believe that yields will come down, that duration will work in your favor. But there's also more diversification, right? When yields are higher, bonds tend to have more of a diversifying value, less correlation with stocks in those sort of environments. And so that's exactly what you probably need if we believe that we're headed towards a recession, at least an economic slowdown. Bonds offer a lot of value, yield, return, diversification.
The fixed income market is vast. It's huge. Where are you finding areas of value and opportunity right now?
Yeah, it's a big market. I think it's worth sort of rethinking fixed income in a lot of ways, right? The way that the environment has shifted so much, it's worth rethinking what's the right opportunity now that that environment has shifted so much. And because yields are so much higher, you no longer need to really stretch in terms of quality down and credit risk to earn the yield that you did for 15 plus years from the financial crisis to the pandemic. Now you can earn a 5+% yield in a high quality investment grade diversified portfolio that mixes treasuries, securitized corporates. And so US core fixed income is one place that fits that mold. But there's also a lot of yield available in shorter duration strategies as well. And so 6+% is possible in the shorter duration. And now that we have an inverted yield curve, those short duration yields are higher. And so for those clients and those investors that are looking for just a more conservative source of income and yield, shorter duration fixed income can serve that purpose.
So what types of products or ETFs can an investor get into to get exposure and take advantage of the themes you just mentioned?
Yeah, those two themes. One would be US core products. American Century, we have a fund called the Diversified Bond Fund. That's really going to be your true high quality core fixed income. Going to give you 6.5 years of duration, thereabouts, yields 5% or greater. And really that low correlation with equities, that diversification that you really want from fixed income. So again, the best sort of confluence of return, yield, and diversification. Now in that shorter duration space, there's ETFs that can work for you too. We have one called SDSI, Short Duration Strategic Income, so that's SDSI. Really nice in terms of 6+% yield, nice income stream, nice source of yield. Without taking a lot of interest rate risk. A lot of clients still are afraid of that, and we understand that. You can still have a 2-year duration, but still get that nice yield on top of that, stay mostly investment grade in terms of quality.
So let's say interest rates do come down. How would that impact, like a short-term duration ETF, for an example? How does that impact the value, if you will?
Yeah. So as interest rates come down, essentially the bonds that you hold in the portfolio that have coupons that are higher than where the current market coupons are appreciate in value, right? It's more valuable to own a bond with a higher coupon when lower coupons are available in the market. And so by having more duration, more exposure to that interest rate change, you get essentially a total return benefit as those interest rates change. And so that's going to be more accentuated the more duration you have in sort of the core part of the fixed income spectrum. In short duration, we also believe over the medium term, let's say over the next 6 to 9 months, while we might see some short-term blips upward in terms of short-term yields, 1 and 2 year yields, those yields are probably going to come down once the market starts to price in more in terms of Fed rate cuts. And that probably will happen over the next 6 to 9 months. And so that's a place where you're going to have less duration, less sensitivity, and less sort of benefit from a return perspective, but you're still going to benefit to a modest extent from rates coming down in the short end. And on top of that, earning that 6% yield in short duration fixed income.
All right, Balaji, we appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.